Give us 1 sec while we let everybody kind of fill in and we'll get moving. Live there. Give us about a minute and we'll get this thing going. Welcome to Wednesday night. Make sure everybody has a chance to get on. Okay, where is that, Ian? Oh, there it is. Give it another second. If you're just tuning in, welcome. We're about to get started here for this month's Real Estate Investing Incubator Meetup group. Just want to get a chance. We're just getting past 7 o'clock right now and just want to make sure everybody who wants to hop on live has the ability to hop on live. So, oh shoot, I need to let the rest of these people in. Hang on 1 sec. I got to keep pushing a mitt every time every time more people hop in.
And if you're on Facebook watching this right now, if you guys want to switch over to the Zoom, because if you want to ask questions, just go to the Meetup link and you can jump on the Zoom call. It might be a little bit easier to get questions out if you're looking to do that.
Yeah, exactly. And the way we typically do our Meetup groups is we'll do our interview for about 30 minutes or so. We have some pretty good questions that I think are going to be beneficial for everybody. We'll keep everybody muted kind of in the meantime. If you have any questions along the way as we're kind of going, make sure you chat them in the chat box. And we'll make sure we have a, we kind of, if they're relevant at this time, we'll go through them. If they're not, we'll wait for the end. And then there's going to be plenty of time for Q&A towards the end of the end of this. So don't worry, we'll have plenty of time to do that. All right, let's just get another 30 seconds. Got a bunch of other people kind of coming in through the waiting room, and then we will get started with Michele. What do you say?
Chris coming? I can't see everything.
Oh, got it. Sorry, I'm a little dark today. I don't have the best lighting, and hopefully this lamp doesn't go out because then I'm gonna have no lighting. But that's all right. The audio is more important than the video. So feel free to turn your camera on if you want. Anyone who wants to keep their camera on, no problem. Since we're not able to physically see everybody at Nottingham's where we usually do our meetup group, at least we can kind of see everybody's faces through this. So feel free to leave your camera on. I think everyone's automatically muted anyways as they've come in. So they won't be able to. If you're just tuning in, we'll make sure there's plenty of time for Q&A at the end. But in the meantime, if you have any questions, feel free to chat them. Also, if you would like just to introduce yourself, feel free in the chat box below to just type in your name and what area you're in and potentially a little bit about you. Real quick. Doesn't have to be even a sentence like, "Hey, I'm Jason from Columbia, Maryland, and I'm Hard Money Bankers." Something like that. Just so everyone can say hi. So cool. Let's get going. I'll make sure as people are kind of filtering in. I know the 7 o'clock time is tough for some people because if you're you have a job and you're not a full-time real estate investor, you might be kind of en route. You might be doing some stuff with your kids. But thanks for taking the time here on Wednesday night. Definitely an exciting guest, and we're going to introduce Michele here in a second. In general, raising capital, not only is it a kind of a hot topic to talk about, but it's an important topic to talk about. And I think there's unlimited information out there related to how to raise capital or finding capital and what to do when structuring deals. But it's more kind of on the business side. It's not really on the legal side. And those two are important. They kind of go hand in hand because, a lot of folks might be raising capital or maybe they've raised tons of capital over the last, however long, but maybe they're not doing it the right way. And, you got to be doing it the right way, right? So that's important. And again, there's lots of content and information out there related to how to raise capital and where to find capital from. But I'm excited tonight, and Ian's going to introduce Michele here in a second, but I'm excited tonight to kind of go through some of the legal aspects of it. I think some of these things are going to be very surprising to people. And also, I also think that a lot of the things are somewhat encouraging. Like, I wouldn't be discouraged about the legal side of raising capital. The first part is kind of understanding how to do it legally. And, after you know that, then you can kind of take action and do it.
Yeah, that's 100% true. And none of us would be where we are today if we didn't have the ability to raise capital. And you might think, well, I only get bank debt and put my own money into the deal. But a lot of this stuff relates, because you should be thinking about how to protect your own capital, or the capital that you're getting from a bank or from a friend to do these deals. So with that being said, I've personally worked with Michele on a few deals now. She did our PPM for one of our apartment deals. We've worked on a few other deals together. And very knowledgeable in this field. So Michele, rather than me trying to butcher your past and what you do, would you like to introduce yourself to everyone?
Sure. Thanks, Ian. So I'm Michele Walsh with the law firm of Gordon Feinblatt. We are a full service law firm. We've been around for almost 70 years now. I haven't been there that whole time. But we, until last month, we were located right in the central business district of downtown Baltimore, and we just moved to Harbor East, though we are still working remotely from our home offices for a few more months. I chair our corporate and securities practice group. So I do a lot of things on the corporate side and mergers and acquisition, but on the real estate side, I get involved typically when usually a real estate lawyer brings me involved to a deal when you're getting bank financing to acquire a building or acquire a shopping center or acquiring multifamily property unit, and the bank says, well, you got to come to the table with some equity in addition to the debt we're giving you. Usually the promoter of the deal is not putting in all of that capital. They're bringing some of their friends into the deal. But when you're bringing, and people just think, oh, we're buying real estate. It's not a security, but you're selling an interest in an LLC that's buying real estate. That is a security. And so there are securities laws that you have to think of. I try to come in and be preventative rather than reactive, because you don't want to, I don't like getting the calls when someone's gotten a call from the Maryland Securities Commission for that an investor.
Yeah, I think everyone's afraid of those three-letter agencies, whether it's IRS, SEC, FBI, whatever the three-letter agency is. And I guess before, you bring up a really good point of that, that you're doing this as a proactive approach to protecting not only yourself, but your investors that are involved in this deal. When people are raising capital, and, let's just stay broad with a lot of these are used in large deals, and we'll start to narrow it down. But just in general, what should us as sponsors and everybody that is doing a deal, whether it's a single family house or a multifamily apartment building, you are the sponsor of this deal when you're borrowing other people's money. What are some things that you should look at to protect yourself in these type of documents? I guess is, what we're looking at here.
Yeah, a lot of it is really just about disclosures. You really want to tell them, all the risks involved in the deal, and, every reason why they shouldn't invest, and to convince them why, that they still, because then you're telling them everything up front, and they can't come back and say, well, I didn't know about this. A lot of times people come back not because they lost money, but because, well, you said I was going to get a 2x return and I only got a 1.5x return. Well, there was no disclosure explicitly saying you're not guaranteed any return. And so that's how it's really protecting the promoter and, the developer in the deal by giving these disclosures. And then typically you want to give a subscription agreement where the person says, yes, I want to invest, $100,000 in this deal. And then there's, pages of representations and warranties that the investor makes. Like, yes, I've had the chance to ask questions of the manager of the company. I understand this is a risky investment. I know I can lose all my money and I can afford to lose this investment. So, you're getting reps and warranties from your investors to telling you that, yes, I understand this is a risky investment and I'm still willing to.
Right. Yeah. And if you haven't seen one of these documents, pretty much the whole documents, you're going to lose your money. You're at risk here. And then the last part of it is like, oh, by the way, this is what you're expected to get. And that's really what it looks like. And, in the end, again, you're protecting yourself and you're protecting your investors. And when it comes to that, when we're looking to raise money, I guess in general, for larger deals, I guess we would say, or really any deal, who can we really legally raise capital from? There's this notion of, well, I can just ask my mom and dad for money, right? Or I can ask my significant other's parents for money, and they'll put the money in the deal and they're protected. Like, what does that look like for everyone that's looking to raise some additional capital?
Yeah, I mean, and a big misconception is people always think, well, I'm just dealing with friends and family, so the securities laws don't apply. And I always say friends and family are only so friendly till you lose their money. So you want to get the documentation regardless of who your investors are. It depends on the state because there's both federal securities laws and then the states have their own laws. So in Maryland, if it's a Maryland entity, you can actually there's two types of investors. There's credited investors, which are the investors I'm typically dealing with because it's the easiest way to comply with the securities laws. And so generally to be an accredited investor, you have to have $200,000 in income or $300,000 with your spouse for the last 2 years, or $1 million in net worth. And you exclude your personal residence and the debt on your personal residence when you're calculating your net worth. If you're an executive officer of the company, on the board, a manager, and anyone who's involved intimately in the company, they're deemed to be accredited. And then on the entity side, you can't get around those rules by just forming an LLC. All of the investors in that LLC that's going to be the investor would need to be accredited, or you need to have, there's a bunch of different rules, but generally 5 million in assets. So it is a fairly higher standard. But generally on the larger deals, you really only want to deal with accredited. Maryland does have it's called a local issuer exemption. So if you're acquiring a smaller piece of property, you need less than $150,000. They do have an exemption that allows you to raise from up to 10 non-accredited investors. There's no filing. You don't have to do a filing with the state. It's called a self-executing exemption. And under the federal laws, there's another exemption you can rely on other than the typical one that we do when we're dealing with accredited investors. Those require a filing with the SEC and a copy of that filing with whatever state. And you have to look at the states where your investors are. It's not just where the company is and where the property is.
Yeah, I think it might be good for us all to break down kind of what some of the documents are per type of investment. And because here's the thing, there's obviously a lot of different ways that you can put together an investment. Like for instance, let's just say, let's just dumb it down to like a fix and flip loan or a fix and flip house. And it's, $200,000 property and someone wants to raise capital for it. So obviously they could raise debt, right? Where in essence, I'm the real estate investor. I want to flip the house and I want to pay a private investor 8% on the money, and I'll give them a first mortgage and a promissory note on the house. You could do that. You could potentially say, hey, you put up all the money, and I'll do all the work or whatever, and let's split the profits. And then it's, 50-50 and there's equity. I'm just trying to flow through a few kind of common ones. And then there's also, hey, lend my entity money and I can just technically do whatever I want with it, but the loan's not necessarily might be secured by the property. It could be secured by the business entity. I feel like those are some of the common ones. Like what type of, because I think a lot of people don't realize that even if you have a private investor that's giving you a mortgage, you still kind of have to have the right thing, the right things in place. What are some of the documents in place that a regular real estate investor would obviously needs in place to be doing this the right way?
Well, yeah, and also let me clarify that debt can be a security. So, if a bank is loaning you money, that's an exemption from the securities laws. But if you're going out and instead of bringing investors in to put equity in your company, you're getting several people though to make a loan to you at a certain percent interest, those are generally going to be considered securities, and you have to kind of do the same disclosures you would do as if you were selling equity. I've done some loan participations where, an investor has a debt and then they're selling pieces of that loan. Those are also securities. So you do kind of need those same kind of disclosure document. You would need a subscription agreement to invest. Now, even for notes. If it's again, and then if it's just one investor and depending on the dollar amount, you could probably get out of it being a security. The thing you said about I want to be a passive investor and you do all the work, that's really where it becomes a security. If you've got two guys coming in 50-50 to a deal, you guys are both actively involved in the company. One person isn't making all the decisions, then it's not considered a security if it's an LLC interest. because it's just like a general partnership. Those are not considered securities, interest in general partnerships. It's really when you have a passive investor and someone else, but your expectation of profits are derived from someone else's effort.
So say that last part again, related to, let's say you have a business entity with 3 members, and let's say one member is the operator and then the other 2 members are putting up capital. If they're 100% passive type of thing, you have to worry, you have to worry about it a little bit more than if they're active. If they're active, then there's nothing.
Active is sort of, it depends on what you mean by active. I mean, does it take, a vote of 2/3 of those 3 members to do things? Can each member have authority, or is it really still one person running the show? People get votes, if you're going to sell the property, they get a vote, but generally management and everything is still in the hands of one person. That's the distinction, whether everyone's really actively involved, and therefore it's not a security because you're not relying on the efforts of others to get a profit. It's an expectation of profit in a common enterprise that is primarily reliant on the efforts of others.
Gotcha.
Yeah, that makes a lot of sense, and that helps clarify for some people that are, So I guess in this scenario, and we're not trying to put you on the spot here, but if someone's flipping a house and one person's bringing the money and one person's doing all the active work to do the deal, could they secure themselves inside of an operating agreement, or would that violate the laws?
It's all risk assessment. Again, if you're flipping a house, it's how much money you're willing, when you're talking about millions of dollars and the SEC comes down and says that you violated the law and they order you a rescission where you have to go back, and if anyone wants their money back when you've already bought the property. But it's all risk assessment. And yeah, so I think if you've got a smaller deal, one person very well, you could incorporate types of reps and warranties I referenced in an operating agreement. Person acknowledges the risk and they understand what's going on. And but again, if it's over 150 and you're in Maryland, then you don't have that local exemption in Maryland.
Right. So everything falls back to the local state. And that's the importance. Again, it's the local state of the investor, not necessarily the local to where the deal is being put on at, correct?
Correct.
All right.
What are some things, let's talk a little bit about communicating with investors kind of on the front end. You're out there trying to raise capital. Like, what are some no words that you should not be stating when you're
guaranteed return?
And
every time I see guaranteed return in a document,
guaranteed return, the word safe typically isn't the best term to be talking about. Can you disclose an interest rate? Not a guaranteed interest rate, but like obviously a projected interest rate.
Right. Well, yeah. I mean, if they're investing in equity, typically a deal I usually see, the passive investors get a preferred return, which is the interest rate, but you call it a return in the context of an LLC. And so typically they're getting some sort of return. If there's money to pay that return, they get paid the return first before the manager shares in the profits. But yeah, so you would normally describe the terms of the operating agreement so they have a understanding of what they're investing in.
Yeah, well, Jason he's a hard money lender, so he comes from the world of debt, right?
Okay.
And we're the real estate investor on our side of things, and for us, we like doing the preferred return for our investors because it gives them some sort of comfort level that they know they're earning some sort of capital, whether it's being distributed or earned during that time frame, and it actually allows us to protect more of our equity because they are getting this preferred payment, so they're already getting money off the top. I see a lot of people like, oh, well, let's just do the deal 50-50. But now your investors, they're not making anything. And if this property needs to be stabilized, they don't make anything versus where we're like, okay, well, you'll earn 8% on your money. And when it's able to be distributed, we protect some of our equity. And it's actually a little bit cheaper because the bigger pop is at the end. And I think a lot of people skip through that. And I guess with it, on that side of things, when you're doing these documents, you're looking to the sponsor for all the information, and you have general guidance to what's standard in the marketplace for some help. But ultimately, they need to dictate to you what they're looking to put in their documents within reason that's guided, correct?
Yes, exactly.
Yeah.
And you can include projections on a deal where this is where you think people are going to get, but you want to make sure that's another thing when you're going out talking to people. Always have disclaimers in anything you're giving them that these are just projections. There's no guarantee these projections will come based on our best estimates, based on our review of the past performance of the property. And a lot of times what we'll do is, they're like, well, I really want to start talking to people to know if I've got interest before I spend the money to draft a disclosure document. So we do like a 2-page kind of teaser. Here's what we're thinking. And again, you've got disclaimers all over about this is not an offering. This won't be an offering of securities or debt until you receive disclosure documents. But this is just what we're thinking about.
Yeah, and that's a good idea because I think it's just like anything else, when going out and raising capital, like no one wants to put money. A lot of people don't want to put money ahead of it if it doesn't turn into anything. And I think what you just said, really, really smart of, hey, let's put together some sort of 2-pager, something quick, at least it kind of covers your butt or, covers us as real estate investors, but ahead of time. And then as things progress and deals start progressing, you turn it into something more formal. Hey, if you're just tuning in, feel free to introduce yourself in the chat. And then also any questions, feel free to just chat them for now. We're going to open up your mics in a little bit, in about 10 minutes or so, to ask any questions that you want live. But in the meantime, feel free to chat them and we can kind of answer them of what's relevant along the way. And feel free to turn your cameras on as well. I know we can't always see everybody in Nottingham's at our normal meetup setting, but if you want to turn your camera on, then we can see everybody here. All right, cool. Ian, you want to keep going? Or you want me to ask the next question?
I don't know. Chris kind of derailed me over here. You already dropped a question that's actually a really good question. And since we're on this topic, we might as well ask it. But Chris Haddon is asking, are the documents always done by the sponsor or can they be done on the investor side?
It typically wouldn't be done on the investor side. Sometimes the investor, if it's an experienced investor, will have their lawyer review it, and sometimes they'll come back with comments. And it depends on if you're going out to a larger pool of people or if it's a smaller group of people. Then the sponsor is going to maybe more willing to accept comments or negotiate the deal. But if it's a broader offering, you said this is the deal, take it or leave it. You're not going to really take comments from attorneys. So it kind of depends on the size of the offering, how many people you think you're going to be dealing with. But it wouldn't really make sense because the investors, you're doing these documents to protect the sponsor. I mean, the investors are getting protections as well by getting full disclosures. But, if I'm representing an investor, I'm not going to say, oh, I didn't get enough disclosures up front. I tell my client, well, if things don't work out, they didn't give you enough disclosures.
Yeah.
So it really wouldn't be on the investor side.
And I think the key point here is that like it's document, right? Like, and I'm not the best person with it in the way that, I think I'm more of I personality and I'm go. My business partner is like, yo, dude, we need documents. And this is why, because everything's fine, honky dory up front. But when things go wrong, this is where the issue is. And, this is why we pay lawyers. This is why we pay everyone to do these things. So everything's in place. And I think, we're talking about some higher level stuff with some syndication type deals or PPMs, some larger asset classes, but this goes all the way down to your single family real estate, right? Like,
right.
You can't just handshake a deal and then something goes sideways and think you're going to be protected. I'm assuming that does not stand in the state of Maryland, that everything needs to be written out more or less.
Well, I mean, it also depends. I guess if you're talking on the debt side or if it's equity, you need an operating agreement.
Right.
That talks, if it's an LLC, that's your governing document that talks about how cash is going to flow, who's making decisions. So that's not even like a securities law issue. That's just, you don't want, it's just like doing a handshake deal. You want whatever it is in writing. And if it's an LLC, that writing is typically going to be your operating agreement.
Right.
Let me kind of dive in with this one. Cause I know a lot of folks on here right now that have raised, good sums of capital for small and large projects throughout the years. And I'm guessing a lot of them have come from accredited investors, but let's talk a little bit about unaccredited investors a little bit. And this is where kind of I'm going on this. Let's just say, let's say you're newer or experienced. I guess it doesn't really matter.
Sure.
And you have a flip that you want to do. It's $150,000 and you got whatever. You have 6 family members that each want to put up, or 6 friends, whatever. They each want to put up 25,000, and chances are they're probably not accredited. What would be kind of the best structure? Because I know that's a common thing that happens all the time. What would be the best structure to do something like that?
Well, in that kind of example, that would fall in what I mentioned earlier, that Maryland limited offering exemption, where you can have up to 10 non-accredited investors. You don't have to do any kind of filing from the securities law perspective. And then you'd probably just incorporate the types of things in the operating agreements, even if they're not accredited. There's, you say they're sophisticated, they have an existing relationship with the person, and
so but if you did it that way, that would be through a business entity, and you do it as an operating agreement. Let's just say they want to.
You're saying they just want to do it individually.
Yeah, let's just say it's a promissory, like they want to do a promissory note. Can they still do a regular promissory note to each one of them?
Yes, but it's still considered a security at that point. If you're kind of selling a series of notes, it would be considered a security. But you could still do it, because I think it would fall under that exemption.
Gotcha. Okay.
If you're not going to have an operating agreement because there's no entity, I still would want some sort of subscription agreement for the note, purchasing the note and making those reps and warranties.
I'm trying to kind of figure out kind of what the most what I believe, and I might be wrong about this, the most common approach that I think a lot of just smaller real estate investors that are doing, just a regular fix and flip, just the best, most economical structure for them to do. And I would guess something like that, either create a business entity, because that's a good option, or some sort of promissory note, I would guess.
Well,
but even, so you're talking about someone who's going to do a real estate investment, but investing in their individual. Like, I always recommend forming an LLC to hold property
per deal,
just for liability purposes. I mean, especially if it's going to be a rental property. I mean, if you're saying it's a flip, maybe
it would probably be a flip.
Just a flip. I don't know, but even so, you're flipping, and let's say someone gets hurt, and, you have insurance, but I always recommend forming a single member LLC to acquire properties.
Yeah. Makes sense.
It costs you $150 to file with the state, and then you got to pay $300 a year. But if you've already flipped the property, you can just dissolve the entity.
Yeah.
Right. Yeah, and this is where everyone starts to get confused, and it's what protects you, right? Like, and that's where, like, some of it, close your ears, don't listen to me here, but like when we first started, it's just like sometimes you have to take some risks to swing the bat, right? You're just telling us worst case scenarios. And I don't want to say, if you listen to Michelle, like, you're never going to do a deal. No, you just need to be aware of what you're doing going forward and what the potential risk to you and someone that you borrow money from. And I'll be upfront and honest. When we first started doing deals, we would borrow money from a lender, like a real lender, like a bank or a hard money lender or whoever. And we would go to our friends and family and say, yeah, we need 20 grand. And we would secure them in second position. That's just how we did it, right? Very rarely did we do equity deals, and if we did, it was just a single purpose entity, and that was it. Right, wrong, or indifferent, that's what we did. And sure, we had some risks there, but we were trying to grow and move forward, So you can beat me up later about that. But either way, that's sometimes you got to do what you got to do. But as you start to take on more money, you need to be very careful and start buttoning down the hatches. And with that being said, is there anything that you need to do for ongoing servicing for investors that you take money from? Is there anything that you need to report to the state on an ongoing basis, or anything along those lines?
Well, the typical, other than that limited offering exemption I mentioned, which is under 150, most of the deals I do are what's called Regulation D under the securities laws. And if you sell to only accredited investors, this particular law called Rule 506. The feds actually trump the states. So if you're doing an offering under this organization, you just do a filing with the SEC, and it's a very simple filing. You don't have to name your investors. You just name the amount you're raising, you name who the principals are in the deal, the total amount you're raising, and you just file that. And then all the states can ask for is a copy of that filing and whatever fee they charge. But they can't ask for a copy of your documents. They can't ask for questions. Whereas if you're trying to use some other exemption from the securities laws, you have to look at each state's, they're called blue sky laws. You've got to look at their individual laws and comply with each of them, and you could be subject to questions from their commissioners. So doing it under this Rule 506, where you just file this one filing with the SEC, is the easiest way to do it. And then if you bring on additional investors from other states, you just update that same filing. You don't have ongoing obligations with the state or the SEC.
Got it. And I know we tossed this term around a lot, accredited and sophisticated. Do we define that? Yes, we defined that at the beginning, right? Sorry, we had a lot of stuff going on in the beginning, but you guys can easily Google that one. And not much has changed to that. under the 506, there was some changes. I keep saying recently, but it's probably been 5 or 6 years now that they've allowed a couple different types of way of funding. Is there anything difference between the different regulations and crowdfunding that falls under here? What does that look like?
Yeah, so it used to just be called 506, and then in 2013, and the crux of 506, a general private placement offering, means there's no general solicitation. You have to have some kind of pre-existing relationship with your investors. You can't send email blasts out to tons of people. You can't advertise your deal. But in 2013, they split 506 into 506B, which is a typical private placement deal, people and 506C says you can actually advertise it. It's still considered a private placement, but you can publicly advertise it. There's a site called CrowdStreet where there's a lot of real estate deals on there, but you have to be accredited, and you can't just have your investors check a box and say, yes, I'm accredited. You actually have to take steps to verify that they're accredited, meaning get tax returns, look at their W-2s. Either you have to do it as the sponsor, or you can have them have their lawyer, their accountant, financial advisor, somebody verify and certify that they have verified. But if you do it that way, you can actually advertise your offer.
Makes sense. Peta, your question, you mentioned why a single member LLC if investing with a spouse. Why do single member? I think really it meant single entity, or single purpose. Sorry, single purpose entity.
Single purpose, yeah.
Which means that yeah, I mean you can have as many people in the entity, but
yeah, I'm sorry, I just meant single purpose.
Yeah. Which means only one property per entity owned by the entity. Is there anything that anyone should be aware of related to the different types of capital that's being raised? And what I mean by that is, let's say you're getting capital from maybe a self-directed IRA instead of a cash account or another way, or does that not matter? I don't know if there's anything different for each.
It doesn't necessarily matter, but a lot of times if you want to allow IRAs to invest, there's just a few more hoops from the actual administrator. They typically make the company fill out some additional forms before they can do the investment. And typically, yeah. So there's not really that much of a difference. Usually offerings can be IRAs as well.
Gotcha.
And real quick with the IRAs, and I know this is probably more of a tax accountant thing, but does there need to be any disclosure that, they're taking leverage, for anyone that has to worry about exposure to UBIT or any types of those things, or is that more of an accountant question?
I mean, typically in a private placement, there is some sort of a tax discussion, and we do talk about UBIT for tax exempt entities and for IRAs. That there is a risk that any income that is not generated specifically from the purpose of the entity, they even though they're tax exempt, they could be subject to tax unearned business income, unrelated business.
Right. Yeah, and we're guys, we'll be opening this up to questions here in a second. Other than that, has there been? And I know these regulations don't seem to change much. Has there been any major updates over the past? Besides, in 2013 when they added the additional class to the 506, is there any updates that people should be aware of that's happened over the past few years? To any of the securities laws that pertains to real estate?
Yeah, not that I'm aware of. I mean, other than they have expanded some of the definitions of accredited investor. It doesn't really help your general day-to-day individual person. But if now if you are an registered investment advisor, if you are a broker dealer, even if you don't meet those income requirements, you would qualify. And the SEC has left it open that they may add additional categories. Perhaps lawyers, accountants are thinking about making additional categories where you would be deemed accredited because of your education. But they haven't done that. The only ones that actually come out are the investment advisor and the broker dealer.
Yeah. Okay. Well, that makes sense. I see. Let's see. Walter Davis says, does $300,000 a year between a husband and wife qualify as an accredited investor?
Yes, as long as you made it for the last 2 years and reasonably expect that you'll make it this year as well. Yes.
Right. And I think one of the things everyone needs to understand, this is my understanding of it in the simplest form. The accredited investor, basically, God forbid something happens, you go to the judge, and the judge says, well, you were smart enough, you lost your money, and that's why the sponsors want to raise capital from an accredited investor, and a non-accredited investor basically just because you make less than that threshold that was 250 or 300, whatever the number is, basically the judge thinks you're dumb and says you might have all the money in the world, but they just think that you're dumb. And okay, well, you should have protected this individual. And I don't want to say it puts the sponsor at risk, but it puts you got to navigate that much better than just, a simple, hey, we're going to do this deal, right? So,
right. Yeah, I mean, they always joke about, the securities commissioners they're mostly concerned about the widows and orphans, meaning the non-accredited investors. But you can be rich and dumb, and as long as you meet those thresholds. And I mean that the reason why you do the disclosure document is because under 506, you don't have to give accredited investors anything, but there's also anti-fraud concerns where, you're not giving them nothing. You're giving them something, whether it's the broker memorandum or you're giving them some info. And so if you're giving them something, you want to make sure that what you're giving them is not misleading, or you omit to give them something that a reasonable investor would want to know in making an investment. So it's really protecting you from the SEC's anti-fraud provision.
Right. Okay. And Naveen Das, I'm sorry if I butcher anyone's names. And guys, if you want to raise your hands, Jason will call on you, and we can bring you in. But is there any limit to how much that can be raised in a 506B offering?
Nope, it's unlimited.
Okay. So, I mean, you're not going to want to go out there and just write, oh, I need $10 million and you only need $1 million. But, if you practically want to do $10 million, you want to pay for that document one time, right? Like, or that's what you need. I guess that's the difference between a PPM and a syndication. Let's see. Vanessa Jackson, when flipping a single family residence, will I need an LLC to protect my personal assets? Or will the property insurance on the flip cover me in the event of a workers' comp injury case? It's a little off topic, but.
Well, I mean, and it's not really a securities issue, but you presumably would hope that your insurance would cover it, but you never know. And yes, they could come if there is an accident, they could come after your personal asset. If it's held by an LLC, there's no personal liability.
Right, and there's depending and that's where it comes down to asset protection and what's in each entity and all that other good stuff, and that's a whole nother discussion on business structure and everything else. But since we're on this topic, I think a lot of the times when you're doing your documents, say we're buying White House Manor apartment, 76 unit building, we paid $5 million for it. We're putting another $1 million into it. It's presumably worth $7-8 million, right? You wanted us to have a special purpose entity to protect that asset, so there's no additional issues. You want to just get into a little bit of the structure, if it kind of pertains here?
Yeah, I mean, I've done deals where you form an entity and you bring the investors into that entity, and that entity holds the property. But more often than not, usually we form an entity that's going to have the investors in it, and then you have a wholly owned single purpose entity that's owned by the other entity that holds that property. And one of the reasons to do it that way is then the parent entity could also acquire other properties and form other LLCs, and each one is held in their own single purpose LLC and it's just for liability purposes.
Yeah, we did a refinance with one of these national lenders who go out and securitize it. They had special purpose entities for this. Sounds like, dude, this is so everyone, you got to come out with the big old chart and start pointing arrows. I'm like, my God. So
yeah.
I think we have a question from
Luis. Let me unmute you real quick. Go ahead. How are you?
Hey guys, I'm good. And yourselves?
Excellent, thanks.
Good.
Beautiful. I'm in upstate New York, so I'm just wondering, does the rules and regulations from the SEC, are they the same nationwide, or is it from state to state that differs? And I need to look into my state to see what they are.
It's both, and it's funny you asked, because actually that does remind me there was a recent change with respect to New York. Like as I said before, 506, the SEC, it's a federally, it says that if you're doing an offering under Rule 506, that is a quote federally covered security, and that's why the states, they can't ask for anything other than a filing. Well, New York, until just this past fall, has always taken the position that they don't care that they say it's preempted. We're still going to require a pre-filing, and they finally came. And the position, New York lawyers, the bar, 200 lawyers signed onto this position paper saying that we think that they're wrong, and we take the position we don't do a filing in New York. New York just passed it. Now they're on board with the same thing. You just do the same filing in New York, and they charge you like $1,200. They charge you something ridiculous in New York to do the filing, depending on the size of your offering. But I think the max is $1,200. So if you're doing a 506 offering, then no, you don't really have to worry about the state laws other than knowing what their filing fees are. But if you are trying to rely, and New York is also a little weird because they're really regulating real estate syndications in particular. I'm not a New York lawyer, so I can't really get into it. I know there's very specific provisions in New York. That is governed under the state laws in New York.
Gotcha.
And just real quick, it kind of brings up a topic, I guess, Michelle. If you're doing more of like a crowdfunding type deal, is that something where you would need to be registered in all 50 states, and you're paying, the registration fees aren't insane, but a few $100 times 50 states, it does get expensive, right?
Yeah, I did do a recent one, but I mean, I think it was a $10 million raise. It was one that was on Crowd Street, and yeah, we had to get a printout of every state where your investors were, and it was probably like $6,000 in filing fees. California is a lot, New York's a lot, Texas is a lot. So yeah, it does, but in the grand scheme, again, you're raising $10 million.
Yeah. It's witching hour over here. My kids are getting a bath. So if you guys hear any background noise, I apologize, but they're just having a grand old time. So it's not a big deal. Naveen, can the docs be reused, or do we need a new set of docs for each offering?
That's a good question. Yes. I mean, obviously you're gonna have to change it per deal, but once we have a decent set for you of, I've got clients where their kind of structure is typically the same every time they do a real estate acquisition. They go through the same waterfall. So it's really then just changing some of the disclosures about the property, if it's going to be a shopping center versus a multifamily versus whatever, you need to change, what the market area is. But yes, you can usually, you can start with the same document. It's going to be a new filing because it's a completely new offering with a completely new entity typically. But you can, that's usually what we do is we spend the money up front to get a good form, and then we just modify it as need to be.
Yeah, and I don't want to quote your price out there to do these docs, but they're not as expensive. You start Googling, people are talking 20, 30, 40 grand. They can be if you get that complex, but if you keep it simple and follow a pretty simple structure, I think you can be pretty cost effective in this space. And if you're willing to give you all the information, like we really lucked out. We knew exactly what we wanted. Here you go, Michelle. And it was a lot easier process, and it was much more cost effective. So I think a lot of people get scared. They hear lawyer,
right?
They hear filings, they assume a lot of money, right? So,
yeah. There's one thing I did want to point out, just because I don't want to forget, and it happens a lot in real estate deals, is finders. A lot of times people, when they're bringing investors in, they say, oh, well, my buddy, he brought me 10 investors, so I'm going to pay him 10% of the capital raise or 5% of the raise, or give him equity in the deal for free. And you got to be careful about that, because that's generally that's going to be deemed acting as an unregistered broker dealer. If you're affecting transactions in connection with the sale of securities, typically in the state of Maryland and with the SEC, you're supposed to register as either a broker dealer or an agent of a broker dealer. Now you do one-off thing one time, they're probably not going to come after you. But if you're someone who does this repeatedly, like gets a cut for bringing investors to a deal, you could be not only could you get in trouble, but you really could get the entity that's paying you the commission in trouble. In the state of Maryland, it says that no issuer shall hire an agent unless they're registered. So the liability is also on the company. I just want to make sure that people are aware.
Yeah, without getting too kind of in detail with that, I think that could be a common thing that a lot of folks might do. It's like, hey, I got guys that have, hey, I've got, I know people that have some capital, you can invest it, give me a little cut of it. So when you say register as a broker dealer, like what does that entail?
You have to, I forgot which exam you have to take, one of the series exams to be.
You have to 7, right?
Oh, it's a real 7. Okay, so
yeah.
So you can't.
I mean, it's like almost like you're a stockbroker, but you're not. You're a real estate person.
Is there other ways to potentially? Is there other ways? I don't want to say around it because that's not the right term. But is there other ways to potentially be involved?
I have structured some. There's a distinction between what's called a finder and a broker. And if you're a finder, you're truly just making introductions. You're not giving out any of the documents. You're just saying, hey, you two should meet. And typically, though, you need to structure it where it's, either like an hourly rate, some sort of a fixed fee. It can't be what's called transaction-based compensation, which is a percent of the capital being raised. Now, you probably back into some numbers, but there's a risk on both sides. You make it a fixed fee. If that person doesn't raise the amount that you thought that you were going to raise, you're paying them more. And if you end up raising more, they would get less than if it was a percentage. But there are some creative ways to structure consulting relations.
Right, and at that point, you could potentially, if you qualify, you could roll the fee that you earned into that deal.
As an accredited, yeah, as an investor.
Yes, participating, right? So there is a way to circumvent that.
So you take the, let's say whatever, hey, I'm going to give you a cut, and I take the cut and I roll it into the deal as equity into the deal. That's what you're saying?
No, you can't take a cut, but
Okay.
if you come up with some creative compensation for providing investor relations and marketing services to somebody, then they can roll that compensation they're receiving.
Got
That's
it.
not transaction-based compensation.
I understand. Non-transaction is the key word for this.
Yes.
Well, now
Walter,
that it's recorded, we got to be real key with our words, right?
Yes.
Like the
Yes.
none of
Hey,
us want-
Walter,
want to be
let's
American.
unmute you real quick. And go ahead. How are you?
Oh, okay, yeah, and along with this same conversation on what you guys are talking about, I was wondering if that person could be added to the entity as like a managing member or non-managing member, and would that kind of be a creative way to compensate that person?
If they are in fact going to be an executive in the company. I mean, you can't just give them a title, if they're really going to be involved, yes, because like I said, managers, executive officers of a manager, partners, they are deemed accredited investors, but that doesn't really get around the broker dealer issue. It gets around the accredited investor.
Well, what happens if their job in the company is raising capital? They're a capital raiser. That's a full-time
kind of
job
what I was
in some companies. Could that be
No, because part of the exemption under Rule 506 is that you're not paying any compensation. It's only employees that are doing the offering, and they're not getting paid to raise that capital. If someone's a professional capital raiser, then they should be a broker dealer.
So, okay, well, let me rephrase that actually. So let's just say Ian and I have an entity together 50-50. Ian's job is to go find, operate the deal. My job is to go find the capital for all the deal. And I still get, it doesn't matter how much capital is raised, I still get 50% ownership though, right?
Right, but you're not getting compensated for bringing investors in. You have a 50-50 ownership, and
Fair
you're
enough.
participating in any profits of the entity.
Either way,
It's a profit share.
exactly. And it's not tied to the specific.
Right.
Okay, that makes sense. And I think,
Either
Walter, that's probably
predetermined,
where
right?
you're getting at, right? You help somebody provide capital for a deal that you're involved in, right?
Right.
Yourself.
Yeah. If you're involved in the deal, yeah.
And that's
That makes sense. Her explanation makes sense. If
Okay,
it's not, the compensation is part of being a part of the deal, not necessarily bringing the people on board, the
exactly.
investors on board.
I think that really helps clarify it too.
Right. Yeah,
Okay, cool.
It's predetermined versus non-transactional.
Exactly. So Michelle, I think we if you can share everybody, share with everybody your contact information, since we're kind of wrapping up here in a second.
Sure.
And if there's any last minute questions, we'll get to that. But while these last minute questions are coming in, maybe kind of, a good way for everyone to get in contact with you and potentially retain your services. Oh, you're putting in the chat. Okay, cool. So, and do you, just because I don't know the answer to this either, do you typically work with real estate investors locally in just Maryland, or what states does your firm do?
I mean, we are a Maryland-based firm, but I'm actually licensed in Virginia as well. I grew up in Virginia, so I went to school in Virginia. We've got Delaware lawyers, we've got Pennsylvania licensed lawyers. But I mean, the good thing again about like a 506 offering is it's a federally exempt security, so it's not a state governed law. So I can do a 506 offering, in any state, because it's federally covered. But if you're talking about like on the real estate side, like reviewing a real estate purchase agreement or whatnot, then we're probably more in this.
Got it. Yeah.
Maryland, Virginia, Delaware.
Yeah. And again, this isn't necessarily what state the business is in, it's where the investor capital is coming from in that case.
For capital raising, yes.
Yeah,
yes.
for capital.
So if I was going to do some sort of an offering that wasn't a 506, I really had to look at each state's bylaw, I would probably have to retain local counsel. I wouldn't want to be making
Got it.
Another state's law.
Got it. Luis, you're up again.
Thank you. Michelle, so just real quick. So if I was to buy, would the rules change if I was buying residential or commercial, and let's say
Doesn't
that I
matter.
was going to Maryland, does it change or is it still the same?
No, I mean, the nature of the property doesn't matter. It's the nature of if you're bringing investors into your project.
So if I was bringing in, let's say that instead of investors, I'm going to go after hard money because I want to close quickly.
So where you're,
I mean, if you're going
so
after
you-
hard money, then yeah, you're not bringing investors.
So yeah, but do you mean raising capital to lend out as hard money, or to raise, or do you mean
What's
you're trying to get a hard money lender to lend you the money?
Correct.
Yeah, then it doesn't matter
Yeah.
because they're just acting as the bank for the most
Right.
part.
But will I
Now,
still
if you were going to do a series of people that are, a bunch of hard money lenders that you're trying to bring in, then it could be a security. But if you're just dealing with, like someone like Lisa who's making loans as a business.
Okay. All right.
Cool.
Thank you.
No problem. All right, we got a few more minutes where we could wrap up early. That's fine as well. Walter's got one other question. Let me unmute you. So
Yeah. So one other question was you mentioned the 150K as the maximum for the waiver. I forget the exact term you used, but to not have to file anything with the state. Does that include that would be from investors, but if I wanted to also, as the person doing the money raise, contribute another 150K for a total of 300K? In other words, does my equity, the money that I put forth, count toward that 150K maximum?
That's a good question, and I should clarify also that it's called the local issuer exemption. There are other hurdles. You can't raise more. The entity can't raise more than 150,000 in any 12-month period. So it's not, you couldn't do another deal right after that. It's 12, it's a period, so you wouldn't be able to continue to do it. I mean, I guess if you're doing a different entity for each deal, then you would be able to do it that way. I'd have to look into that as to whether it's an aggregate amount. I guess if you could do it as, you're a Class A member and you're only raising capital from Class B members, I think you could do it that way. Like it's a different class. You're putting in your money as a founder, so you're not raising money from investors. I'd have to look into it more. That's never really come up.
Okay.
Good question.
And that's actually that kind of brings me to a point. The founder shares in some of these larger deals can be treated in the same way that your investor money is, and it's something that you just need to declare up front, right? Like all the other shows that we've ever done where we discuss sources and uses and how we're going to do our construction and what type of fees we're looking at. We've done other shows in the same sense. This all starts to relate as you start to scale up and do these things. And honestly, I didn't realize it until Michele pointed it out to us. Is like, hey, you need to tell us what you're doing with the money that you contribute into this deal. How is it being treated? So that was actually a good point that sparked another interest. Michele, we thank you for coming on. It was an awesome show. We got a ton of great information out of it, ton of great comments. If you guys want to drop a comment in there and let us know how Michele did, let her know how good of a job she did. Is there anything that you want to leave here for us?
No, it was really, I thanks for having me. This was really great. I like working with investors and educating people. Like I said, I find more often than not, most real estate lawyers don't know they're dealing in securities. So that's where I get a lot of my referrals are from real estate lawyers that are not at my firm, but at other firms.
Excellent. And also, just in case someone's listening to this in the future and not watching this, her Michele, it's Michele Walsh, mwalsh@gfrlaw.com, and her number is 410-576-4216. And we got a lot of thanks, Michelle's, and Naveen. Her contact information's in this thread, and also there will be a replay of this. That as soon as I download the Zoom, we'll put it up, and we'll send an email out. And also, all of these replays typically go on REINetworks.com, REINetworks.com, completely free site for real estate investors. So, Michele, thanks again. Go ahead, Ian. One more.
No, before we go, we got to wish Danny Ballenlock, Jason's brother. He's down in Kiwa. His brother's playing in the PGA Championship, so hopefully He does well. Best of luck.
You know what else we need to do before we go?
We gotta go. That's it.
It's Ian's birthday today.
Yes, we're out of here. It was
birthday!
very
And you know, last time we did one of these, everyone unmuted and sang him happy birthday.
all right, we
and,
gotta go.
and we don't have to. We don't necessarily have to do
pee.
that.
We gotta get out of here.
If you don't want. But happy birthday, Ian, and Michelle. Thanks again.
Sure. Thanks, guys.
Thanks,
Happy
guys.
birthday.
All right,
See
see you
ya.
guys.